have already presented on my channel several videos about investing into real estate, meaning rental property, and its benefits and pitfalls in retirement. For example, is property a good investment in retirement? Or another video, keep or sell investment property in retirement, or property, shares or super. I have never, however, spent much time discussing the topic of shares as a separate asset class, which is really weird considering that I love investing into shares. Australians generally have a love-hate relationship with Australian shares. On one hand, we love them because they provide a relatively reliable level of income with beloved franking credits that are a very special thing of the Australian tax system, which I will explain in another video. But at the same time, we hate shares due to their volatility. As humans, we are drawn to immediate results, such as a very high fast market reaction and increase in share prices. But we hate when the reaction is to our disadvantage, meaning share prices are dropping in value. But you see, one cannot exist without the other. For shares to go up in value, someone had to drop them and sell them to you at the reduced price. And if the economy is right and enough shares get sold at the bottom price, eventually the price just have to go up. And if you happen to be a buyer for the stock, you are a winner and you make a profit. During the low interest rate environment we've had for years now, it was very easy to make profit with shares, even just with the level of reliable income they pay. Why would you have kept any money in a term deposit that was paying close to nothing with CBA or NAB or Bendigo Bank, where it was enough to buy shares of whichever bank and your level of income jumped to between 5 to 9% per annum plus franking credits, which we all love. As I mentioned before, I will explain the idea of those franking credits in my future videos. So I think by now you have gathered that I am a big supporter and an investor myself in Aussie shares. However, as good as they sound on the surface, you really need to do a little bit of homework before you commit any of your money to invest into Aussie shares or any shares for that matter. And if such homework is not your cup of tea, ask for good advice. My name is Catherine Eastbrand from About Retirement. I'm certified financial planner and you are watching About Retirement TV, the place that provides you with all the financial information you need when you are preparing for retirement or if you have already retired. One of the funny things about stock market is that every time one person buys, another person sells, and both think they are astute. I love this saying because it virtually confirms that we humans can justify any of our decisions, even if, or maybe I should say especially, if they are our mistake. So why I love investing into shares, especially Australian shares. Aussie shares are very special and a different kind that you have in Europe, UK or America. Our Aussie shares, especially top 50, as much as the underlying asset, can sometimes be a little bit volatile, meaning the actual share price goes up and down. The level of income for years has been very reliable. We had a little bit of disruption due to COVID and now rising interest rates, which impacted on companies' cash flow. But in general, the level of income has been for years very reliable and extremely tax effective for many retirees. The problem appears that some people get spooked with that volatility very, very fast and see drop in a share price together with all the doom and gloom you hear or read online, and sell high quality shares at the most unfortunate time. And this could be a direct shareholding or through a superannuation fund or a pension fund. But in reality, what is happening now is that by keeping all funds in cash, there is no capital growth and no income being derived. So my question is this, and it is exactly what I say to every single person that I speak to. If you own a house that is worth $1 million, would you sell it to someone just because he or she offers you $800,000? Please answer this question before I continue. Well, would you? I bet you wouldn't. Well, why not? Here is $800,000 on the table. How do you know that the next person would pay your price? Or maybe you actually don't even need to sell this property at all. Well, the same philosophy lies behind shares. Why would you sell good quality Australian companies just because their share price dropped? This is still the same bank, or the same BHP, or the same Wesfarmers, or Woolies. It's just that today someone is offering a lower price. But wait few days, few weeks, and the price will be what you paid for, or maybe even higher. The funny thing is that when that price goes higher, this is when most people don't want to sell, because maybe that share price will go even higher, and if I sell today, I might miss out. So in both cases, either selling at a reduced price or not selling at the higher price is the issue of our internal greed and a fear of missing out. Nothing wrong with this, it is a human nature. But once you understand it and accept it, rather than denying it, your investing in shares can be so much easier with less fear and more content. Now, please remember, Aussie shares, as good as they are, they constitute only about 5% of the world market. So you need exposure to other markets as well. And I will talk about other markets in another video. When investing into shares, diversification is the key. You have to invest into a range of shares from different industries, as they all perform in different cycles. And investing into 4 banks is not diversification at all. When banks go down, they all go down more or less together at a very similar pace. So what sectors can you invest into? Well, there are 11 stock market sectors: health sector, materials, real estate, consumer staples, consumer discretionary, utilities, energy, industrials, consumer services, financials, and technology. Each of the listed sectors has specific industries, and then you can choose the best companies in each industry and in each sector. Why diversification between them is so very important? It is because it is virtually impossible for all sectors to be dropping or growing at the same time and at the same pace. Therefore, whether you are after a good solid level of income or capital growth, that diversification is a key to reduce volatility of the underlying value of assets or your income. I hope you found this introduction to shares investing interesting. And if so, please like this video and subscribe to my channel not to miss my next video. Don't forget to visit my website about retirement.com.au, where you can find lots of information about preparation for retirement, superannuation, age pension, different forms of retirement income streams, and lots more. While you are there, please sign up to my newsletter to stay always up to date with all the financial news that can impact your retirement. Now I invite you to watch those previously mentioned videos. The first property shares or super, which is a big question many people preparing for retirement are asking. So hopefully this video will assist you. The second recommendation is keep or sell investment property in retirement. I will be speaking with you in my next video. Bye for now.